After years of delay, Kenya's capital markets are finally ready to launch a derivatives market in equities in mid-July. The Nairobi Securities Exchange spent most of the second half of 2018 testing the trading infrastructure with participating banks, and that included Stanbic Bank's local subsidiary and Corporative Bank. The East African nation launched its first exchange-traded fund back in March 2017 when the Barclays NewGold ETF started trading. From mid-July, however, you will be able to trade in single equity futures based on some of the most liquid stocks. That includes Safaricom and the country's top two banks by assets, Kenya Commercial Bank and Equity Bank. Earlier on, I spoke to Adembesa. He's the head of the derivatives unit at the Nairobi Securities Exchange. As he pointed out, don't expect to hear about leverage in the first phase of trading.
Something peculiar with how we've proposed to launch the market is that ours is going to be based on cash collateral, right? In other markets, you trade blind, and then at the end of the day, collateral is called upon. But ours, it's pre-funded upfront, so there's not really much risk per se because the potential default is already paid up. Okay.
So effectively, that also sets a sort of natural trading limit because you can only trade up to your cash limit.
Exactly. Right. Up to your cash limit. And what we have done is then also apply a haircut to that cash limit. So you're not trading all the way to 100% of your cash. But explaining, getting a lot of players, including credit risk teams in banks, understanding that concept took a bit of time. And that's what has taken us this long.
Well, since you've mentioned it, let's get into the mechanics of how this is going to work. So why start with the cash float approach instead of just going straight into a naked position or essentially providing people with the option to actually take on leverage in order to short whatever stocks they want?
I think two things. One is the knowledge on such products was a lot of people in this economy understand derivatives from a textbook perspective. Right. They've never, not many people, fund managers included, have interacted with derivative instruments directly. So there's a learning curve that needed to happen. The other thing was that derivatives work well when you have some sort of well-established underlying market. So as the exchange, of course, our comfort levels is that we have a fairly stable and established equities market. And so based on that, then, we have a spot market, we have a few liquid stocks, we have an index that we can use, then would load, a derivative product off those products.
By design, because when you start talking about trading against a specific cash position, to me that sounds as though this is going to lock out your average retail investor, because then, they'd have to put in a certain amount of capital in order to be able to actually trade in the derivatives, and that by itself would essentially limit it mostly to institutional guys.
So what we've done is structure the contracts to be of decent sizes that a retail investor would be able to participate in, and that's one of the key success factors about derivatives markets. If you look at economies, for example, in the BRICS and emerging markets, that's majority of these countries with derivatives markets have tried to put the contract size small enough that your retail participant can jump in. So, for example, the equity contract would be about, I think 1 for 1,000. So that if you take the index,
1,000 shillings.
Actually, I think it's 100. So the value would be, say, if the index is 4,000, and it's 4,000 for 100, that's about 400K.
Yeah.
And if the margin requirement on that contract is 10%, then you're looking at ticket size of 40,000. So that's the amount of money you'd need to participate on that contract.
Right, okay.
And if it's a single stock, say for Safaricom, which is 25, but the ticket size is 1 for 1,000, so that's 25,000, and the index is, though the margin requirement on that contract is 10%, then you're looking at what, 2,500?
Yeah, which is actually pretty accessible.
Which is, exactly. So it might be a bit of slight inefficiency for your institutional clients, because then it means they have to buy many contracts. But for your retail participant, then it's easy to.
But the flip side of it is that it actually provides the volumes that you'd require, while also cancelling out any of the hedging risk.
Exactly.
Right.
Exactly.
Okay. So who's in place? It's
yeah.
Safaricom.
So we have
KCB?
Safaricom, we have KCB Equity, we have EABL, we have BAT, Bamburi is there, and maybe one or two other stocks.